And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Of course, it's Wednesday. We'll be doing Q&A today, taking your questions, your comments. So if you log into our YouTube channel right now, join the chat. And want to ask whatever questions you want to ask, we'll be happy to answer them for you. Well, as best as we can anyway. Always happy to do that. So again, log on now to our, well, if you're not logged on right now, you're listening to the show. But if you're watching the show and you haven't subscribed to the channel yet, be sure and subscribe. Be sure and like the stream. Helps us a lot. But put your questions into the chat. Danny's monitoring chat right now, and he'll start kind of putting these questions together. We'll get into those here in just a few minutes. A couple of big pieces of big news today, of course. After the bell, we've got major mega cap earnings coming out this afternoon. So that's going to be one of the market movers tomorrow, right? So we'll get Microsoft and Meta and others today. So again, we're right in the heart of earnings season. So we're getting a lot of big major S&P 500 companies reporting all this week. So it's going to be very busy in next week as well. So again, over the next 2 weeks, we'll have about 80% of all S&P 500 earnings in over the next 2 weeks. So it's going to be very busy here. That's going to contribute to the market movements as we've talked about yesterday. Today also is the Federal Reserve announcement. It is expected right now that the Federal Reserve will leave rates flat at the moment. That makes sense, given that the New York Fed right now expects GDP growth for quarter one to be around 2.7%. So again, plenty of strength in economic growth. Stronger economic growth should help bring inflation up a bit, because again, that's part of what's going on. It's that consumer dynamic that should also help lift wages. So if we're getting 2.7% growth, and that's what's going to come through the pipe, and it's not just, if this is actual economic growth and not just an inflection of kind of a net export issue as we've seen over the last 2 quarters, it should start to put a little bit of a bid under inflationary pressures that should also lead to higher wages. Again, both of those good, right, for the economy, but not good for raising rates, right? So again, not surprising the Fed may be on hold today, especially with kind of the data starting to look a bit stronger as we go into 2026. Remember, kind of the story for this year, and this is why small caps and mid caps have been doing well, is this idea of economic reflation. And this economic reflation story in the economy does not require the Fed to cut rates. So again, we'll see what the Fed says today. It'll be very interesting. But right now, the expectation is that the Fed will remain on hold today on rate cuts. But again, we'll see what but what's going to be more important than whether or not they cut rates is going to be their outlook of what they say about future rate cuts and what they're seeing about economic growth, those type of issues. So we'll get that this afternoon at about 2 o'clock. That'll certainly kind of move markets towards the end of the day. Coming out of the gate this morning, stocks are a little bit stronger, and again, that's good. So we'll talk about that here in a second. One of the interesting pieces of news, though, overnight is that the Bulletin of Atomic Scientists have just released their new atomic clock update. They have now moved the Doomsday clock. That is, since 1947, they've been publishing the Doomsday clock, which back in 1947, remember, we had just gone through World War II, bombed Hiroshima and Nagasaki with atomic bombs, and this really brought the whole idea of nuclear Armageddon to the forefront. And so the Bulletin of Atomic Scientists started to publish this clock saying how close we were to midnight. Of course, if we get to midnight, it's all over, right? So you don't want to get to midnight. Well, they moved it last year from 89 seconds to 85 seconds to midnight. So a little bit less than 2 minutes. But there's an important change in their bulletin. And this is the one thing that nobody has talked about. Again, these are atomic scientists focused on nuclear Armageddon. But beginning in 2007, they have now started including, guess what? Climate change. And now emerging technologies. So we now have in our case for nuclear Armageddon, the atomic scientists are now adding in climate change as well as artificial intelligence as now the end of the world. So we're now 85 seconds to the end of the world. It's been, between that and about 2 minutes going. So by the way, 85 seconds is a minute 15. So it's been between a minute 15 and 2 minutes ever since 1947. They actually used to publish dates when we would actually hit midnight, and those kept failing to occur. So they stopped publishing dates. So
did they run that through ChatGPT?
I'm not sure if they ran that through ChatGPT, but they said that fake news was one of the big issues starting around COVID. So
no kidding.
Anyway, but we're 85 seconds to midnight. So just go enjoy today, right? Because we're right there. It's all going to be over soon. And far as I'm concerned, can't happen soon enough. So
how much can you get done in 85 seconds?
I'm ready for a dirt nap. I'm just telling you. My dogs woke me up at 2 o'clock in the morning wanting to eat. So I'm just ready. Just do it now. Let's get it over with. Anyway, okay, let's get into the market real quick here. Here's what you need to know before the bell. So market set an all-time high yesterday at the close. So again, we're right there at all-time highs. Markets are doing fine. We've actually seen a pickup over the course of this last week. We talked about this last week, is that kind of the mega cap technology stocks have been really kind of lagging the markets over the last month or so, and we were kind of due for a rotation. We actually saw that rotation. Mega caps have been doing well here, kind of going into the earnings announcements today. So we've been seeing some bid going into Meta and Apple and Google and those type of stocks going into earnings, which will happen after the bell today. So expectations are, of course, that those earnings will be good. But we've seen this push up in the S&P 500, the large cap stocks. So this is market cap weighted, right? So this is the mega cap stocks kind of driving this index, as compared to the equal weighted index, which has actually been kind of weaker over the last few days. So again, we've kind of seen that rotation in the markets, and we've also seen it in small cap stocks also have been under a bit of pressure here over the last few days. So we've seen that rotation from kind of the small cap, mid cap, back into the large cap stocks here over the last couple of days going into earnings. So again, not surprising. We've talked about this rotation potential over in last weekend's newsletter in particular, saying, hey, these stocks were very, very oversold. Kind of look for this rotation to occur. So that's what we've kind of seen this week so far. Again, it's a minor rotation, but it just was kind of what was expected to happen. But like, for instance, on small cap, mid caps, you're very overbought, about to trigger a sell signal, and kind of, so again, you've had this kind of really nice run in small cap stocks. Another reason, think about taking profits, kind of rebalancing risk. So again, you've had this nice run. So again, you're about to get a trigger, a sell signal here. But if we go back to the S&P 500 as an example, you're now just triggering a buy signal from a decently kind of, you're near kind of fair value levels for the market. So you're kind of triggering a momentum buy signal at a much better position, and you're not really overbought yet. So you've got some room to move here. So if earnings are good today after the bell, we could see the S&P 500 do a little bit better tomorrow again. But again, it's not going to be so much what these companies announce, because a lot of that earnings have been kind of tapered in a bit here going into this reporting season. So they're going to beat their earnings. We'll likely see Apple, Meta, Google, everybody, Apple and Meta today. I'll get this right in a second. Microsoft and Meta today actually announced better than expected earnings. Revenues will be better than expected. What's going to be important in particular for Microsoft is the data centers, as well as for Meta, is going to be data center outlooks for their CapEx spending, et cetera. So that's really what's going to move the stocks tomorrow more than anything else. If they're maintaining or improving their CapEx expenditures, kind of feeding into that AI narrative that they've invested heavily in, that's going to be their outlook's going to be much more important than what they actually announce in terms of earnings revenues, because they're going to beat on those fronts. It's just going to be what their announcements are going to look like. So again, just kind of tomorrow going into this, if these earnings are good after the bell, we could see this market make some additional highs today. Market's going to at least this morning right now. Futures are higher, so we're going to kind of be making a new all-time high in the S&P index this morning. But we'll see if that, we've had this very kind of bifurcated market over the last few days. Again, we've kind of seen this rotation from staples, which were overbought, kind of coming back into these oversold kind of technology stocks. We'll see if that continues today, or if we start to get a kind of a broadening out of the rally, starting to see kind of money come back in across the board. So we'll kind of update you on that tomorrow. But again, just kind of think about where your risk is right now. Again, small caps, mid caps, very overbought. just kind of look at that. Emerging markets very overbought here as well. So again, there's a potential here for a bit of a rotation. So just kind of make sure that you're kind of managing your risk accordingly. Okay, that's what you need to know before the bell this morning. Let me move over to the other set, and we'll pick up with your live Q&A right here on today's edition of the Real Investment Show. Again, give us that thumbs up because it helps us with the algorithm, so we appreciate it this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome to the show this morning. Danny, good morning. How are you?
Hey, good morning. Doing great.
Good. So my computer is on the fritz this morning, so you're going to have to handle the Q&A.
Oh, even better.
Good. Okay, so I'll
You'll defer?
I'll see you tomorrow.
Perfect.
So good.
All right.
Okay,
great.
Very good.
See you. All right, so we did have a poll question. So if you guys have not answered that poll question, please go do so. So what topic should we prioritize today during the Q&A? And we've got a lot of different information in. 41% of you want to hear about market volatility and technical signals, which I think you just addressed really well. But Federal Reserve and interest rates were 16%, portfolio risk and rebalancing 26%, and investor psychology and sentiment only 17%.
Nobody cares.
No. But I think this is really important, and we've been getting a lot of stuff on this.
Okay.
And all you metals guys in here, I'm talking to you maybe just a little bit. And listen, when we talk about metals, everybody thinks that we hate them. But I see something, and Lance, I know you see something as well, from a psychological perspective of what people are doing right now. And I think it may be worth a couple minutes to kind of step back and maybe take the metals aspect out of the equation, but just talk about assets that have gone up exponentially in a short period of time, and maybe what the intent should be and what we're doing with them. Because I think in general, we're seeing a lot of people chase returns. Mm-hmm. And, the big thing at any big institution or any financial really is that, you see these disclaimers that say past results do not guarantee future, or past performance does not guarantee future results. Mm-hmm. And I think that's something we always have to be mindful of. And the psychology aspect is I'm beginning to hear from more people in many different areas, and questions we receive through email and via just talking with people is that they're starting to look for these enormous returns that maybe just aren't achievable or necessary.
Right.
And so maybe dive into that just a little bit, especially when we see assets going up. A couple of you alluded to taking profits. I'm always a big fan of that. But what do you think about kind of the dynamic that we see right now? It feels reminiscent of some other times we've seen here recently.
Well, I mean, look, it's what's always fascinating, right? Talking about investor psychology. So right now, retail investors are now piling in to, and there was actually just a chart out this morning showing retail investors are. So when you look at retail investors, I'm gonna spit this out. But when you look at retail investors, one thing to kind of look at is where are they piling in their assets. And normally, most retail investors pile into either an S&P 500 index or VOO, which is the Vanguard S&P 500 index. Those are kind of the two, SPY and VOO, those are the two favorite trading symbols for the retail investor. Trading volumes of the silver ETF over the last 2 weeks in particular, now are at the same level as the trading volumes of the S&P 500 index. So what's not surprising is always when an asset price goes up, retail investors start chasing that asset price. And this is what's really interesting, because I was posting this, I was talking about this the other day, is that when I was on Fox Business, that investors want to buy what's going up, and so they want to buy what's going up the most, right? So what's the first job of investing, though?
Well, buy low, sell
high,
yeah.
right?
Yeah.
So this is a chart of silver, which has been doing great, right? So you've had this great parabolic move in silver. It's been fantastic. What's interesting about this chart, though, is that when you have a parabolic move in stocks, everybody's like running around going, oh my, stocks are going parabolic. It's a melt up. It's all going to crash and fall off. But when silver is going up or when gold's going up, making a clearly parabolic move, that's okay, right? So again, I want to buy more of this because it's continuing to go up and this is going to go up forever. But I don't want to buy something like, say, an Apple, which actually has revenue and sales and earnings and those type of things. I don't want to buy that's already had a nice correction, is decently oversold, and is a good position to make a rally, right? So I don't, it's just kind of a fascinating psychology. Here's another good example, emerging markets. So what's been one of the big narratives for the U.S. stock market over the course of the last year? This is actually fed into the gold narrative as well. Is like, oh my gosh, the U.S. has a 6% deficit to GDP ratio. We're all going to go bankrupt, so you better have gold, because if you don't have gold, we're all going to go bankrupt, and gold's going to be the only thing that matters. So everybody's buying Brazil right now.
Yeah.
Right? You know what the deficit GDP ratio of Brazil is?
Which is
it's almost 8%.
Nuts.
Yeah.
Yeah.
So, even the narrative that is used to support the trade. And so here's the whole point is like, look, precious metals are doing fantastic. Our all-weather model, which has precious metals in it, is doing fantastic. Returns are great. We're up like 225% in our silver position. We've taken profit. We have no money. We have no principal value left in our silver position. It's all profit now. So it's interesting though, the narrative doesn't support the thesis, but it's just these narratives that we use to justify buying higher prices. And there's nothing wrong with it, right? There's nothing wrong with it at all. Precious metals are doing great. But historically, right, going back, just pull a long-term chart of silver going back, 50, 60, 70 years. These spikes have occurred 3-4 times in the past for various reasons. And then you're going to give up 50% of, a 50% retracement is all of your gains. You're going to give up all of your gains at some point, because silver in particular is a industrial metal. It's used in making EVs and solar panels, all those type of things. So the supply-demand imbalance when price gets very high is going to revert itself, as with the case of inflation, right? High prices are always the cure for high prices. So again, that supply-demand imbalance will reset itself. Things will return to normal. And look, there's a national security issue of getting prices back down towards $30, $35 an ounce in silver, because of the input cost into manufacturing things like GPUs and AI data centers and all that stuff. That higher price of silver is driving up all the cost of that. So there's a national security issue for bringing silver prices back down to more normal kind of operational levels. And that'll occur at some point, but it could be a year from now.
Yeah, and I think that really you just need to exude some caution here. And if you do have the opportunity to take profits, go for it. There's nothing wrong with that. But, we're seeing too many people who are just sitting and or throwing the kitchen sink at it when you've already had this parabolic run. Exude some caution here. Maybe I'm not going to say common sense, because that's going to make half of you mad out there, and I'm sorry. but essentially, right, it goes back to the very beginning. Buy low, sell high. And this is a great opportunity. I know plenty of you out there sitting on, truckloads of actual physical silver and gold. This is why you have it. Everybody initially said, oh, it's insurance. It's insurance. Well, you have that opportunity to take chips off the table. I think this is a great time to do so. Just be careful, especially if you're putting more money into something like this. It doesn't mean that it cannot continue to run. But what is your exit strategy? You need to look at this just like you would any other asset class, and know that, hey, I've got to get out at some point. And yes, somebody just mentioned, well, I sold way too early. Well, did you make a profit? You said something a while back, Lance.
And you don't sell it all, right? When we talk about taking profits, we're not selling everything. We still have plenty of weight in our portfolio of precious metals, uranium, silver, gold. It's all in there, right? But it's just we're taking profits on. Like I said, we have no principal risk. And silver could go to zero tomorrow, and it would not impact our portfolio because we have no principal value left in that. It's just all profit. We just give up gains, right? So It's just again, I was having this conversation with Adam Taggart last Friday because he's a big physical silver guy. And, so he's got big boxes of silver sitting around the house. And I'm like, why wouldn't you sell?
He's going to get robbed now. Thank you,
Bro,
Lance. He does not actually have boxes.
It's not even in a
sitting.
safe. And I'll give you his address. So anyway, and he has no guns. So even better. Look, and this is the one thing about having gold and silver. It's awesome, but you better have a lot of lead to go along with it. Because if the end of the world ever occurs, right, I'm going to come to your house and get your silver and gold, right? So, because I have plenty of lead. But the issue is, I told him, I said, look, you've got prices that you're not going to see again for probably 30 years. Yeah. Right? Because we go through these cycles. And so even if it just goes back to $50, fine. And it sits there for 10 or 15 years, fine. You give up all these gains. And so great, you still have your metal, it's still sitting there. It's going to trade at 30, 40, $50, whatever it trades at. He's like, well, it's okay. It's insurance against the future. I go, you're going to die before that future happens. He's like, okay, I'll give it to my kids. So, okay, great. You're going to give it to your kids. You could have given them the cash at $100 an ounce in silver versus giving them metal at 50, right? So, it's just an asset. You've got to get rid of all these narratives and just understand that commodities are just an asset. We're just investing dollars. We're just trying to make our dollars make more dollars. And how we invest those assets or invest those dollars is fine, right? If people talk about, silver and gold, whatever. Well, since 1920, right, investing in stocks has far outperformed everything else on the planet, period, in terms of inflation adjustment, purchasing power parity, and all these type of things we want to talk about, making sure that our value of our dollar remains its purchasing power. Everybody's concern is like, oh, the dollar's losing purchasing power. Yes, it loses purchasing power to inflation over time if those dollars are uninvested. So we have to invest those dollars, and we just want to choose an asset class to invest in. So stocks are great. Bonds are great. Bonds have outperformed inflation over time. Gold is great. It's outperformed inflation most of the time. So those are some great assets. But don't forget to take profits. When you make a lot of money, put that money in the bank, invest it in something that's cheap, that is now going to make you some more money in the future, right? That's all we're ever saying. It's just, manage your risk and manage your assets.
Yeah. So speaking of taking profits, and then obviously the inflation aspect and kind of where that is going, what do you envision right now? So lots of questions on the weaker dollar. We're supporting potentially the Japanese yen. What does that mean for inflation over time? And has the Fed lost their 2% mandate?
Oh, wait, are we talking about the dollar or are we talking about the Fed mandate?
Both, right? Because they go hand in hand, essentially, right? I mean, if the dollar's being devalued and we're looking at inflation.
Yeah, but that's not the way. So first of all, the dollar is down a little bit.
Yeah.
But it's still in a long-term uptrend, right?
But we had an enormous run here in the last several years where everybody said the dollar was going to nothing, essentially. And now we're seeing a little bit of, pullback in the dollar.
Well, yeah, we had a huge run when 2022, right? We had a massive spike in the dollar, and you didn't have inflation, right? So all the dollar is just the relatable translation between the U.S. dollar versus the Japanese yen, or the U.S. dollar versus a basket of currencies. And so when we talk about a weaker dollar, we're just talking about a dollar that's weaker relative to another basket of currencies, right? Yeah. So the euro, the pound, the yen, whatever it is. So the dollar's just weaker compared to that. Those currencies are stronger than the dollar. So right now the dollar declined, yesterday because we're theoretically intervening into helping support Japan at this moment, right, on their yen. So again, it's just a narrative more than anything else. It's currency traders at work, but that's not really going to feed into inflation. It's actually a weaker dollar is good for the U.S. because it allows us to export more goods, because our goods are cheaper now relative to purchasing power of other countries. So in other words, the euro is stronger than the dollar, so now I can buy U.S. goods cheaper, and we export those goods. So it's actually good for U.S. corporate profit margins. It's good for the economy. So, again, but the dollar is still trading near par, right? So par value for the dollar is 100 going back against a basket of currencies is 100 going back to 1974, whenever we started tracing this. We're trading at 96. So we're at 96 relative to 100. So we're just slightly below par. We were just at 100 just few weeks ago. We just had this little bit of a sell-off here over the last week or so. But it's really, it doesn't mean anything other than it's just we're trading against a basket of currencies.
Yeah. All right, I'm going to put you on your heels here for just a second, or your toes. So got
Heels,
a question.
toes.
Actually, yeah, toes, ideally.
Ankles.
Whatever. Long as you're standing for now. So to pay off or not to pay off your home. So somebody has $80,000 left on their mortgage, under 3% rate.
Paid off.
Paid off? Well, what about
it? It's $80,000. Now, if you had a $300,000 mortgage, no, you don't pay it off.
Well, that's always funny because that's what I'm hearing from most people is like, pay it off. But is that really the right answer?
Well, I
think there's a whole lot of contingencies that are associated with it.
Okay, so let's you have to clarify a few things, right?
Well, those are the unknown things we don't know
Is
right now.
80,000 all you have in the bank?
Correct. Are you pulling it from a retirement account? What else is that going to do to your basically your expenses? What's your mortgage payment, and what is that as a percentage of overall debt?
Yeah.
What does the rest of your debt look like? So these questions we get, they're great. I love them. Keep them coming. However, it's very difficult to give a really educated answer without more information. The one thing I will say is that if you don't already have a lot of money saved, and if you're down to the last $80,000, you're probably playing primarily principal. We can play a bit of arbitrage. If you can make more money in money markets, savings, CDs, or the market or another investment, great. Obviously, we think that's what you want to do. You're probably not getting a big write-off because most of that interest has been paid. Mm-hmm. That's one thing I've heard a lot of from people.
Yeah, I think if you can take $80,000 and go to Vegas and lose it, and it doesn't make any difference to your financial outcome, go pay off your mortgage.
But then it goes deeper, right? I mean,
no. What I'm saying is this, right? Is like for some people, $80,000 is nothing, right? They have $3 million in the bank, whatever. Go pay off an $80,000 mortgage. Get rid of the headache of having to send out the mortgage payment. Personally, I never pay off a mortgage. I never pay off because even if rates are at 4%, I can loan money at 10 to 12. Yep. So I'll just pick up the arbitrage, and so I never pay off mortgages because I just take the interest deduction on the mortgage tax. It's the last one that you get because they took away credit cards back in the 90s. You used to be able to deduct your credit card interest. So it's the last one to get, and I'm just living there. It's always the interesting. It's like, I own my home. No, you don't. You're renting your home. You're paying a mortgage payment, or you're paying taxes forever because if you don't pay your taxes, then they come take your home away from you. So it's just a different form of renting. But I don't like being asset rich in terms of I've got all my money in my house, which in order to sell it, or in order to get my money out of my house, I have two choices. I can sell the house. But if I sell my house, I've got to go buy an equal priced house and put that money right back into it. So I really don't make any profit because I got to live somewhere. So I either have to go rent or I've got to take a HELOC on the house and pull money out of it. So I don't really like having all my money tied up into a piece of real estate that I'm living in right now. If we're talking rental properties, pay those off because you just want those to cash flow, right? So. But again, $80,000, if it makes no meaningful difference to your financial outcome and you just don't want to pay the mortgage payment, fine. But again, if it was a $300,000 mortgage, no, don't pay it off.
Well, and I think for some people, it's just literally peace of mind. It may not be the best decision, but you also need to think if you don't have a lot of assets, then you're turning water into ice. It's very difficult to go and chip away at that home. And yes, you can go get a home equity, but most of the time when people think about doing that, it's too late because they've lost their job. They need it for another reason. So if you have all of the other foundation laid, great, go for it. But yeah, always an interesting question. So the next question, what do you think about, and this is an interesting one, tokenizing real estate holdings? So kind of putting on blockchain, utilizing fractional shares, allowing people maybe to invest in things that they weren't able to do. I think we already have that to some extent, right?
It's coming, right? Yeah. And again, we just had this interview with Parker White on Monday talking about cryptocurrencies and Bitcoin and transactional basis. And, over the course of the next few years, we're going to be transacting more and more through stablecoin. And one of the side benefits of that kind of transactional basis is that banks like JP Morgan's already moving in this direction because you can speed up cross-border payments with stablecoin. And so we'll eventually move into potentially tokenizing a lot of assets through stablecoin. So we'll see, which is also really interesting. I've got an article I'm writing about this right now, following up on our conversation with Parker. But this is also a huge benefit for U.S. Treasuries down the road, because as you have to start using stable coins to transact these digital transactions because of the lack of volatility, right? The whole purpose of having a stable coin is so you can do transactions on cross-border payments. You can do them very, very fast. They're instantaneous, but it requires treasuries to back them up. And so already Tether is the 17th largest holder in the world of U.S. Treasuries currently, and that's just going to keep getting bigger and bigger. So it's got a really interesting byproduct for U.S. Treasuries down the road.
And so you think that that's going to create more demand for it?
Yeah, absolutely. Yeah, look, like right now, right? So as a good example, I do a lot of lending. So when I want to send somebody money, right? So we sign a loan document, and where I'm taking collateral against where they have, that takes time to set up those liens, do all those type of things. But then when I go to send them the money, I send the wire today, and if I send it too close to 2 o'clock in the afternoon, or if I miss the 2 o'clock window shut off for sending out a wire, they don't get it till the next day. And so there's this 24-hour turnaround. Well, with using something like stablecoin with that type of a kind of a blockchain background, it's instantaneous. I mean, I in theory, right? In theory, if this all comes to fruition, then in theory, I can file liens instantaneously between parties and then send them money instantaneously. Like I push a button and it's there immediately. It's kind of like using Venmo. If you send money on Venmo, they immediately get it, right? Yeah. So again, that's using kind of that technology in the background. Companies like PayPal and Stripe are all moving in that direction. So it's just a function of time. JP Morgan is moving fast in that direction as well. It's only a function of time. Next couple of years, most everything we do will be through probably some form of blockchain for payment structures.
It's interesting. Years ago, and I bet this is over 10 years ago, I was buying books on blockchain just to try to get an understanding of it. And the adoption was supposed to be here already. Medical records, financial statements. Yeah. What's been the holdup on, the adopting of the technology?
Just legacy structure.
Yeah.
It's just, look, it's like moving the Titanic. Think about how large the world infrastructure is for financial transactions, right? Yeah. SWIFT, those type of facilities. It's very hard to move all that legacy stuff overnight.
Well, and somebody's missing out because you're taking business from somebody on the other end.
Exactly.
So they're lobbying to keep it.
Yeah, the banks have fought it for a while they've they've been working on it in the background, but they've been fighting this for a while because, again, they kind of control that system, and it's a hard shift to move that into this environment. Plus, you also don't want to move it fast because you need to make sure there's security and that transactions are safe. And look, there's been fraud and those type of things with Bitcoin and other cryptocurrencies. There's been fraud that's occurred, FTX, et cetera, Mt. Go. So again, you just want to make sure that before you make this switch and you get everybody moving in that direction of digital transactions, that it's safe and secure and functional and those type of things.
Yeah. All of the oversight needs to be in place. All right. So question on a Roth conversion. Jason, thanks for the question. Early 70s, have looked at conversions, cannot see any value. I think it's going to be different for everybody. If you're pre-RMD age, you can now go do that up to maybe IRMA or maybe even a little bit more, so where you're paying a little bit of Medicare premium. So we just need to understand exactly where your assets, what type of distributions are you going to be forced with required minimum distributions, and then really, are we going to see higher taxes at some point? Now, that's a hypothetical aspect of this whole kind of scenario or rundown. If things are status quo, maybe not. Maybe it's not a big deal. If the majority of your assets aren't in retirement accounts, then this may not pertain to you as much. There's not a one hard rule that everybody should do a conversion. However, depending on what the intent is for the funds, and if we potentially see higher taxes, there can be made a pretty good argument to do so. Also from a legacy perspective, if you're going to pass down to kids, it can be a great way to move funds to them. Traditional assets, you're going to have to take those out. Traditional IRA assets, you're going to have to take out within a 10-year time frame, whereas the Roth, you will have to do, your heirs, non-spousal, will have to do the same. So make that consideration. Those are the big things I would think about. If you think you're going to have higher taxes, if you have a bulk of your funds in a traditional IRA, then, and you have legacy intent, yeah, I would start to think about it. But run the numbers, and you're going to have to look at some different scenarios in regarding that and those back pocket taxes. All right, another good one here. And I think we're kind of already seeing this in a lot of ways, Lance, but how does an economy work in an AI environment without jobs or purchasing power from the masses? Where do the buyers come from to support companies that replace the workforce with robots? We're already seeing that. Mm-hmm. We've been seeing it for years, for decades. I mean, think about...
You ever been to a auto manufacturing facility?
Yeah, exactly. That's where I was going to go. Think about warehouses, manufacturing. Look at the robotics that are already there. Yes, they're not some, humanoid walking around, but that's been happening for decades. Adoption is getting quicker as technology ramps up, but, there will still be plenty of jobs out there. I'm telling my kids, go look at trades. Start to entertain that. I think for years we've done a poor job of, oh, you don't want to work outside. You don't want to go do this. You want to get this cush job in an office. I don't know that's all it's cracked up to be. And I think there's a lot of open opportunities that are there that, those aren't going anywhere. Those are not going to be taken over by a robot anytime soon. Going back to houses, it's kind of funny. We were talking about that a minute ago. Last night, my kid had a basketball game. We're driving home. He's like, Dad, you can buy a house for $500. And I was like, what are you talking about? I was like, yeah, probably not one you want. He's like, no, there's a sign that says $500 down for a new house. Mm-hmm. And I thought, all right, so great time to kind of talk through that. And so, well, how does that work? What does that mean? So we kind of had that discussion on, well, if you put $500 down, what's your interest rate going to be? And what is the intent of most of those people? They wanted you to actually get out of that home so they can redo that and do it over again. Now, probably lucky it's only $500 because a lot of people will do much more. And in that instance, you're probably paying 10 or 12 or 15% on a mortgage, and you're never paying any principal off. So anyways, kind of interesting. Lance, you should create a private fund for lending.
No. And by the way, don't post stuff in chat that you have no idea what you're talking about. I know you're thinking you're funny or whatever.
Oh, you're in now.
Well, no, I can see this over here now. But like one guy posted that I lend out at 10 to 12% and our portfolios pay 6%. And I'm not, no, this is not client money. This is my personal money. This is what I do on the side for my own investing. So yeah, that's me. That has nothing to do with our client portfolios. I would never invest client portfolios in risk assets that have no liquidity. That would never be done in this firm. And secondly, our portfolios returned 14% last year. So, shut up.
Depending on the allocation, everybody's a little
different. But yeah, we were just reviewing the 60-40 yesterday. So.
No. And so, I do think that's a good point. So we're talking about a whole lot of different things here. And I think like the majority of you have assets invested in different areas and you're diversified. We eat what we preach. I mean, we have money invested in the markets. We do a lot of different things. And I think that's a key element to any stable or long-term type of retirement plan should be that you have different types of assets that you invest in. So keep that in mind. But
yes, I do need a side job to pay for my wife. So yes, my wife has big dreams, and it involves many goats and many cows. So,
oh man, yeah,
it's never going to happen. But she said that she was reading this text yesterday or this TikTok yesterday about people who take Ambien. And the stuff that they do during when they're like having Ambien hallucinations, like this one lady's running around her backyard chasing a possum in her nightgown and bare feet. And she tore her feet up doing this, but there was no possum. She was just outside chasing an imaginary possum. And so I told her, I said, you're never allowed to take Ambien. And she goes, why not? I said, because I'll come home and there'll be goats in the backyard.
Yeah, that's right. Yeah.
Real goats will be in the backyard. And my backyard is AstroTurf, by the way, so they'll be really upset.
And this is why we have to keep our wives separate and away from each other, because they would be buying all the goats and mini horses and chickens and all that fun stuff. Yeah, not so cheap. So I'm trying to get back through here.
No, Scott, do not go sell your gold to buy a Porsche. I would be tempted to do that too. I'll give you a good story about this. I have a wonderful friend I've known for 30 years now. 35 years. I've known him forever. He started a mortgage company here in Houston called First Houston Mortgage way back in the 90s. And in the 90s, he was buying .com stocks and he was day trading and doing all this kind of stuff. And he made a ton of money trading .com stocks till it all blew up. But the one thing he did really well is that he sold Yahoo in like 1999 and bought a Porsche GT3. And loved that car, and it was great. And of course, now he doesn't have the car anymore because it gets old and, that type of stuff. So yeah, don't buy a depreciating asset for your investment money. But I do agree with you. The need for speed is always a good thing, right? So.
Wait, if you buy the right ones these days, some of those cars, those supercars have appreciated.
Yeah. No, absolutely. You buy a Ferrari, you store it, and you're great.
All right, so this is a good point. Had a couple conversations as of recent where I'm talking about somebody took a ton of risk and did phenomenal on trading, like life-changing, and they're very young. What would you do? Like I'm talking about you can retire, potentially.
I wouldn't. And the reason is that, there's a lot of people that strike it rich early for one reason or the other, right? And then you retire. And if you take a look at what's kind of going on in the economy right now, what are retirees doing, Danny? What's the latest poll?
They're going back to work.
Yeah. By large numbers. Yeah. Right? Everybody was expecting that 65 they're going to retire and you're going to go right off into the sunset. It's going to be great. Problem is you get bored.
Yeah.
And, then there was this, I was actually talking about this yesterday with John Penn on Two Dads on Money, is that back in, about 10 years ago, there was this whole FIRE movement. Remember the whole financial independence, retire early? So all these kids were saving up $500,000, going to buy a van, drive around the country, do that type of thing. Well, the problem is that, something happens and, to the markets, you have a big crash, you're not paying attention to it because you're on a beach somewhere and you lose a big chunk of your money. All of a sudden you got to go back to work. Well, now you've got a skill gap because you've been out of the workforce for so long.
Yeah.
Right. But again, the reality is that retirement sounds great on the surface, but it's boring after a while. And so you're going to want to do something. And, the great thing about if you make, in fact, John Penn's going to be meeting with a young gentleman that is 30 years old, made a whole bunch of money betting on markets. And he's like, I want to retire. And so now the question is can you kind of talk him out of that? Say, look, go do something you want to do, but stay active, stay involved, let your money continue to work for you, make some income on the side, whatever, or go start another business, whatever you want to do. But, those are the decisions that, you kind of have to make over time. But, generally retiring early, I've seen a lot of people try to do it and they always wind up going to work or doing something else within a few years. Because you only play so much golf. You can only go, drive around the country so many times, whatever you want to do. Whatever it is your hobby is fine. But after a while, it's like, I kind of need purpose, right? And one of the big things about, being fulfilled and being happy is not just the money part, but it's also having, a fulfilled life of having friends and family and purpose, and good health, obviously. So take care of your health. But those are very important to your financial well-being.
Yeah, I think that's a really valid point. That sense of purpose is something that diminishes quickly when you're not there, having something to actually physically go do and provide some additional value. So you've got to find that kind of happy median if you are going to retire, especially at a very young age. Another thing was, want to travel. Well, that's great. Find time to travel now, take that opportunity, but continuing to keep that human capital going is extremely important. And if you can continue that and kind of have that balance, that's going to be much better long term. And especially if you're at a very young age, you can run out of money a lot quicker than you think. And if you have some tax advantages for depending on how funds are invested or what type of accounts, I think you utilize that to the best of your ability. But be cautious in that aspect. There was a couple more questions before we're done here.
Yeah, Scott, don't sell aluminum siding when you retire. That was the worst job I ever had. We were talking about
siding.
We were talking about this yesterday about how 9 to 5 jobs suck. And I tell you what, you go sell aluminum siding, you will do anything for a living other than sell aluminum siding. So Scott, no, don't do that.
All right, risk versus age, allocating, and when or what points does one rebalance? I think it's a great question, very common, and it's a difficult one to answer because it's going to be different for everybody depending on your situation, what your assets look like, what your expenses look like. Ideally, when markets are expensive, take some chips off the table. Lance was alluding to this earlier. If you have assets that have gone up substantially, go ahead and take profits or take your cost basis back out over time. Doesn't mean you have to sell everything, but just kind of bring that back in line and then have that strategy to know, okay, hey, if you're getting closer to retirement and you are older, maybe we don't want to be as aggressive, but you need to think about what is it that you need? What do we need to back into? What's that rate of return? Because I think in an environment where, hey, things are going up and we feel very strongly about an asset that we've been in, we can get emotional and not make that more pragmatic decision on saying, okay, hey, let's take some risk off the table. What was the purpose of these funds or this investment? You got to back into it sometimes. I think that's going to be key.
Well, look, I think, as with all things, risk and volatility are two very different things. And we often equate volatility to risk, and it's not. Volatility is volatility. And which only means that prices go up and down. So when you're thinking about your allocation, a lot of people make the mistake, I don't want to lose any money. So, I want a really conservative portfolio. But then the market goes up a bunch, and then you're like, but I'm missing the gains, so now I want to be more aggressive, right? So all you're doing is trading volatility is all that's happening there. Risk, on the other hand, is the function of investing in something that can lose some, most, or all of your money, right? So, destruction of capital is the thing that you're trying to avoid. And yes, there is some relation to that to volatility, but volatility doesn't necessarily equate directly to a capital loss, right? In terms of catastrophic issues. Volatility is part of that equation, and they certainly can mirror each other at the same time, but volatility is a function of our return structure over time. And we want volatility in our portfolio so we can make returns to meet our investment goals. We just want to control that price movement so psychologically and emotionally we can weather the storm long term and make gains in the markets. What we want to try to avoid, though, is assets that can have 30, 40, 50, 60% collapses in a very short period of time and destroy our capital base that we have to work with in order to grow that capital over time. Which is why we spend so much time talking about risk management, taking profits, rebalancing risk, those type of things. Because what we're trying to avoid is the risk of capital destruction. We're not trying to avoid volatility. Volatility we want.
Yeah. Well, in volatility, we have to be cautious with that as well, because if we look at portfolios with similar returns, the one with more volatility, if we're just holding it, is actually going to have a little bit less return from an asset perspective. Now, if you're trading it, you love that volatility. If you're young or you're dollar cost averaging into funds, that volatility is great because you're buying assets at better prices. Long-term trends typically are going up, but we do have to be cognizant of where the markets are. I know we're trying to shut this down, but we've got one question twice, Lance. Mm-hmm. CME is raising silver margins at the end of the day. What should we expect in regard to prices?
Well, historically, look, so what CME does is they raise the margin requirements. Now, they did something different this year, and this was in December, and it implemented at the beginning of January, right around the beginning of January, is they've now put an algorithm in place to adjust the margin rate automatically. What the CME is trying to avoid is a situation where prices move up too sharply and you have what's called failure to deliver. And that creates financial strains within the commodities markets itself. So they will keep hiking margin rates. This algorithm's now doing it automatically until they eventually break the market. And that's why if you go take a look at silver historically, it has these nice big spikes and then has big corrections. And normally you'll see in there that the CME was hiking margin rates during that requirement to get prices back down into a more normal level. And that's eventually going to happen again. This algorithm's doing it automatically in the background. And it doesn't happen automatically. It doesn't mean just because they hike margin rates once or twice or three times that you have this kind of reversion to the mean in commodity prices. But they are hiking that rate, which is requiring investors to hold more and more collateral behind their trades. And so eventually that margin requirement gets to the point to where it's not advantageous to leverage that trade anymore, and then you lose some of your demand, right? So what drives prices higher is supply and demand in the futures markets, because that's where all this occurs. And so once that margin requirement gets to a point to where it's no longer advantageous, that's where you start getting your price reversals. But that, again, that could be months. It could be several months before it gets to a point where that occurs.
Yeah.
So be tomorrow.
One last question here. So have you changed your all-weather portfolio 60-40 to 40-40-20, or about where is that now? Keep in mind, when we talk about a lot of different things, and portfolios are going to differ. We kind of have our core flagship portfolio, which, most when we talk about it, we talk about 60-40. If you look online, you see 60-40. That can be anywhere 20-80, 40-60, 50-50.
70-30.
Yeah, 80-20, 100% equities. But
we have 80 different models altogether. So that because everybody has different risk tolerances, profiles, wants, needs, blah blah blah. So you have different. It's all the same assets, right? But you just have different allocations.
And that sounds very overwhelming, I think, when you say it out loud. But it really, if we talk about that same model that's a 20-80 or an 80-20 is going to own the same exact stocks. It's just going to be at different percentages based on your risk tolerance, what you're trying to accomplish.
Right.
Now, the all-weather portfolio is going to be less risky in the sense of, from a 60-40, it's going to differ. That is not a 60-40 account.
Right.
We're looking at metals. We have metals like Lance alluded earlier. We've sold some silver in there, taking profits on something like that. Large cap value. You have bonds. So
it's based on the all weather model is based on the permanent portfolio theory.
Correct.
Which is the permanent portfolio theory says that you should own 25% cash equivalents, 25% bonds, 25% commodities, 25% stocks. And over time, that has weathered. That's why it's called all weather. It's weathered every type of event. It, weathers the .com crises and the financial crisis, and it makes money during bull markets. It's great. So, now ours is a little bit different. We use that kind of premise, but the portfolio does. It owns 10 very good value dividend-oriented stocks that just crank out dividends over time, and it grows with the markets. It has the commodities in it. It has the bonds in it. It has cash equivalents in it.
Has real estate.
So we rejiggered it a little bit, but it's just to provide a good, stable, long-term return with less volatility. That's the goal of it anyway.
Yeah, and keep in mind a 60-40 that 40 can be cash. 60 can be cash if we're in a really bad market, since we're not your traditional buy and hold. We're not day traders by any stretch, but we will mitigate risk to the downside. We operate by a very defined discipline. So that's the target, but we may be overweight, we may be underweight, depending on the environment. We want to mitigate risk when possible. We cannot avert risk, and we can do our best to mitigate it. It's, like I said, it's not always perfect. But lots of good questions today. I don't see any. I'm sure we're missing a couple of you out here. I'm sorry. Ask them next week.
Yeah, exactly. So, but we do have to kind of wrap it up for today. We're going to went a little bit long today. Thank you for hanging out with us. Be sure and like and subscribe to the show. It really helps our algorithm a lot with Google. So give us that thumbs up, and we certainly do appreciate it very much. And we'll see you back here tomorrow with Michael Leibowitz talking about what the Fed says today and, of course, what it means for the markets, etc. Also, we'll touch on earnings reports tomorrow from the big boys that are coming out this afternoon. So, again, lots of stuff going on. Microsoft today, Meta, Tesla, ASML Holdings, Lam Research, just a whole variety of them. So we'll have a lot to talk about tomorrow as well with Michael Leibowitz. All right, y'all have a great day. See you back here tomorrow.